Good afternoon, everyone, and welcome to our second commercial webinar of 2023. Today, we are talking about the top commercial banking trends in 2023. And with us today, we have Janet Pasco. Janet is the market president for Horizon Bank and has served business owners in the Metro Detroit area for over 30 years. She is an experienced middle market commercial lender with expertise in healthcare and real estate, and a deep passion for impacting the local community with redevelopment financing for neighborhood improvement and for helping businesses grow and prosper. She is also a certified wealth management advisor and a licensed commercial broker. Welcome, Janet.
Thank you.
Yeah, we are very glad you could participate today. All right, Janet, let's dive right into what's on everybody's mind. And there's a couple of things that we'll talk about as far as what's trending in commercial real estate. So the first thing we're going to talk about is interest rates. We all know that they are higher than they've been for several years. And in fact, the Fed just raised the interest rates another 0.25%. These rates are expected to bring deposits back to commercial banks, which is a positive thing, and provide more funds for commercial lending, and also provide some catalyst for growth. But in turn, it may delay purchases and refinances. So two-part question here. What do you see interest rates doing in the balance of 2023? And what changes have you seen or do you anticipate for this on the commercial credit side?
Well, great. Thank you, Maura. I was voting against the raise of the 0.25 point. So I'm a loser in the most recent activity. So that leads me to believe that kind of the general guidance that there's probably going to be another 0.25 point raise in the second quarter and then tailing off to nothing is probably the way it's going to go. My interpretation is that the Fed chairman doesn't, even though there's, I think, good reason to stop the raising of the rates, he doesn't want to be perceived as soft or weak. So he's chosen to kind of stay the course with these smaller rate hikes to prove he's on inflation.
Okay.
So, but what you're also seeing, besides the Fed funds rate going up, this modest rate, in exchange, the 5-year Treasury rate went down almost by a similar amount. So the market is telling us that they think longer term rates are definitely going to decline.
Which is good.
Which is good. Yes.
Yeah. So do you think there is a commercial credit tightening because of these raises in the interest rates, the increase in the interest rates, or how is that affecting credit lending?
It's kind of a natural tightening because projects, especially new projects or even purchases of buildings, when you have to underwrite to a 6.5% or 7% interest rate compared to when we were at 4% a year ago, the metrics of the deals change dramatically. So it naturally is causing demand to be lessened.
Right. Okay. All right. The second big issue, I think, that's on everyone's mind. What effect do you think that the bank failures will have on the growth plans for banks in 2023? And what about the effect on commercial borrowers' confidence?
Great question. I think it is going to further lessen demand, and just because people are going to naturally be more conservative. That's what we saw, that hangover from the last Great Recession for a very long period of time. People were, even when they jumped back into the market, they were only doing things that were kind of gold-plated. So I think when interest rates are super low, people say, oh, I can roll the dice. This one looks like it's got a lot of potential upside. Now, I think they're going to be taking a more conservative approach and trying to minimize risk. So I think we're going to see a lessening of demand. Our leadership has indicated we're still growing, and our plan is to grow this year. And as recently as last week, we have not changed any of that. But I think it is just going to be a natural thing that happens. I don't know. I can't speak for all banks, just our leadership, but we're still in it to support our community and grow the economy where it deserves to be grown.
Right. I mean, there's still a lot of great projects and potential out there.
Yes.
It's just a matter of people being comfortable with that and deciding to do that. just a follow-up question on that. Because of those bank failures, have you gotten a lot of customers that have called you to find out, number one, what your thoughts are on those failures, and number two, how your bank in particular, because that's all you would know, how you're doing and whether you're, resilient and collateralized and
Right.
tell me what you've seen there.
We have, but I would say it's 10 to 20% of our clients have actually called. It's actually a relatively small minority. And we have a number of clients that we're looking at diversifying their deposits. So using the CDARs, where you share kind of CDs across banks. There are ways to manage that FDIC insurance risk that we've put in place. It's a lot of work to do it, but we definitely can manage risk that way. So we're in that, but that also is still only 10 to 20% of our client base right now.
Right.
Yeah.
And why do you think that is? Do you think that consumers or customers understand what's happening and maybe feel more comfortable with a regional lender than?
I think there's a huge difference between what happens on the coast and what happens in Middle America. And the banking industry truly is very strong and well diversified overall. These institutions that failed were very narrow, had very specific niches that were high risk oriented that they were dealing in, that led to their demise. Crypto and startup venture capital tech firms are not our bread and butter over here in good old Michigan, right?
Right. Yeah, I think that's a great point. So for all of those watching, gives you some assurance and what to tell your customers if they ask. So you were talking about growing. Your bank has continued plans for growth. And so that kind of leads into my next question. Bank branches. So even in our industry, in the title industry, we've seen less bricks and mortar expansion and really more organic growth and digital growth. The commercial banking industry has benefited from reduced costs associated with lessening their geographic footprint, as have we over the last few years, even prior to COVID. So what are you seeing as a trend in this arena? Are branches making a comeback?
I don't think so, Maura. But before I dive in deeper, I think you really do have to look at it between the commercial customer versus the consumer. Everybody benefits from good use of electronics, but the consumer really has benefited. Unless they're opening a new account or coming in to close a new mortgage, they almost have no reason to come into a branch. You can do everything through your phone or through your computer app in terms of
including closing a mortgage transaction or a sale transaction through remote online notary.
That's right. If you work with CSS, you can, right?
We do. We offer that. So, okay. So that's on the consumer side.
On the commercial side, there's still a lot more personal touch and handholding. Although we do have the electronic banking for all of our commercial customers, but there's still more involvement from their banker relationship manager with regard to various transactions, or even something as well. I'll get a text, Janet, I sent through an electronic deposit and I got this funky message, right? I don't know what it means. Can you check on the back end? So in theory, I guess I could do that from anywhere, but our organization believes in having local service teams of people in the local markets to serve the clients, to give that personal touch. So in our experience, commercial borrowers actually like that. They like to actually know who is really helping them and is going to be there for them when they run into thorny problems. So, but that being said, I don't really need to have my people spread all over Metro Detroit. If we need cars, we jump in the car and go to the client. So Horizon's model, as we've expanded across Michigan, is to concentrate on having one or two locations in each metro market, so that people can get to the bank in a reasonable time frame if they need to, but knowing that this market change has really occurred. It's very much a once in a blue moon that people actually need to come to the bank. Maybe if they're not set up for electronic wires because they thought they would never need to do one, now you have to come to the bank and actually sign all the papers because they're trying to prevent fraud by doing it that way.
Okay.
And that's an emergency need of, oh, I better stop everything and run to the bank if I need to get this wire out. But other than that, we come to them. There's not a huge need for them to come into the branch.
Yeah.
So.
Okay, good. Thanks for making that distinction too between consumers and commercial clients. So we had talked about, digital signing and remote online notary. So getting into that in the metaverse. So online is really the default choice for our Gen Z, which are fully digital customers. You had mentioned, mobile apps. They all want to do it on their phone. They don't want to leave what they're doing where they are. They want to make it most convenient. So the metaverse is going to enable us and the commercial banking industry to connect with customers, not in person, but maybe in a far richer environment digitally, and all under one roof. So from your perspective, what changes on the digital front do you anticipate to see in 2023?
Well, that is a great question. I will start out by saying that banking makes changes slowly in this regard, but slowly but surely they are definitely happening. One of the things that we're doing at Horizon is working on an online front-end portal to take applications in and try to start to gather some of that initial information electronically. Right now we're doing it the old-fashioned way where somebody calls or sends us an email and we say, oh, well, that sounds interesting. Let's get on the phone and talk, and then we'll send you out a list of all the information we need in order to pursue that application. In theory, if a customer knows we have a good front-end portal and it's secure, they could start that whole process themselves at 9 o'clock at their couch,
Right.
Right. When they're not distracted or whatever. And right now they're waiting till business hours to start that whole process. So it is definitely changing. And as you know, we are also piloting remote closings and trying to get to the place where we can meet the needs of our clients no matter where they are. We have many deals where there's multiple partners in a transaction, and one partner's, they're out skiing in Denver, but it was convenient to close the loan for everybody else on tomorrow, right? And so then how do we loop that person in without delaying the whole process? That the remote online closing can really facilitate that,
Right.
and enable you to have the best of both worlds.
Right. And as we've been doing remote online notarization for 8 years plus now. And like you said, sometimes it takes a little bit longer to go through all the banking red tape and regulation that needs to be had before you approve something. And, we get that, but I know that you're working on it. Other lenders are working on it. And I think we'll get there one day. And that's why we even try to do, kind of hybrid type things. But you're right. It's, if one partner's here, one partner's here, it makes it more convenient. So that's great. Do you agree that the ability to use digital tools and technologies to create something new and innovative is really a business must for banks right now? Even for competition,
Yes, but tempered by the need for security and having, multiple layers of redundant security. So
right.
It's almost to the point of no fail. They're not going to let anything slip through the cracks. So in the short term, while we're going through this conversion and figuring it out, it seems to take longer to do things digitally than it does the old-fashioned way. But I think we'll get there.
Right. I know. And, risk is one of my things I was going to ask you about. So not only is there the risk of failure or losses due to the rise in unemployment, which drives delinquencies and foreclosures, basically, but you also have the additional risk of cybersecurity, basically. So we might as well dive into that then. Are there different approaches to risk management and to commercial banking operations due to higher risks, both on the, cyber side and on the delinquency side, more so now than before? And if so, how so?
On the cyber side, I would say there's a mistrust of anything that looks too electronic and too slick. For example, last year we rolled out an automated system to send emails to our clients asking them to upload the ongoing requirements for financial statement providing. Mm-hmm. And we're seeing a huge percentage of them not want to open that email, not trust the email, or they're afraid to click on the link that enables them to upload.
Because that's what we've been taught, right?
Right.
Scrutinize your emails. Never click on a link. Never open a PDF. Right. To get something out of the blue, they're very, distrusting. And I would have been distrusting too, unless I got an advanced phone call that said, "Hey, we're going to be doing this."
Right. Yeah. So we're either having to send a very personal, folksy email and next to it, or making follow-up phone calls. And a lot of times, we even have some clients that have had their identity stolen that refuse to give us anything electronic. They literally are overnighting us packages of hard copy information that then we have to turn around and scan and upload.
Right.
But at least it's all within the bank then, and they can't, and our security is great. So I think the risk of it getting, out into the public is minimal, but.
Right. Yeah. But then that's not really saving you any time, not really saving the customer any time.
No.
So, hopefully we come up with some kind of a happy medium, but, wire fraud is so rampant, and we have customers every day that are fearful of sending a wire. And we have multiple different security systems and things at play in order to ensure that doesn't happen. But it still doesn't lessen, what they're feeling.
Right.
So,
yeah, we require an actual phone call person to person to verify wires.
We do too.
Yeah.
And most title companies do now also, which is great. And I think a lot of it is just educating the customer to let them know. So, yeah.
Absolutely.
So let's talk about commercial asset classes. What commercial real estate asset class are you being asked to finance most often currently? And how has that changed maybe from a year or two ago?
Yeah, great question. What we're seeing most currently right now is still a strong demand and request for new multifamily new construction and light industrial build to suit and self-storage new construction. All of those asset classes are still kind of under supply mode. So there is demand no matter what the costs are, right? The people still need more places to live. So if the developer can make their numbers work and their interest rates at 7% now, they're willing to pay it because they're in it for that long haul. It's still there. It'll still be a profitable venture. What we're seeing a huge decline in is acquisitions of new investment real estate. For people that are building their portfolio, and also refinances of any asset class.
Sure.
So retail, we've seen hardly any activity in the retail. Office sector is completely dead because of the impact of remote working. Everybody's kind of waiting and seeing what's going to happen with the existing office supply, and talking about, can we repurpose it into other types of ventures as well, which I think we're going to see more of that as time goes on, but we're seeing kind of onesie twosies of potential conversions of offices.
Okay. Yeah, that was going to be my follow-up question. When we had an economist a few months ago on a webinar, we talked about conversions and how those present its own challenges with, because you want to use the best and highest use of the property. And, but there's considerable amount of money that is involved with that and red tape to get things approved by the local municipalities. So, you'd mentioned construction, a couple of conversions. So I'm interested to hear more about construction. Is that being consistent? Is that an increase from last year?
Gosh,
Or what are you really seeing on the construction end?
I would say that the overall volume of new construction has been tapering off over the last 2 years because of the costs and the increased costs, not even of just interest rates, but the cost of materials because of the supply chain disruption.
Right. Okay. But you're still seeing some construction.
Still seeing some. Yeah.
Okay. All right. Yeah, I mean, we've noticed construction files basically tapering off also. And it'll be nice, though, to see those increase, hopefully, come summer. I don't know, any thoughts on that? Do you think there's any room for increase? I mean, there's room for increase, but any chance of it increasing in 2023?
I think it's kind of slim myself.
Yeah.
I did just see a statistic that home prices dropped on average across the nation 12% in February, which is obviously that's the existing home stock is getting more affordable now that interest rates are higher in order to even out that what is your monthly payment going to be and is it in an affordable range?
Right.
So I think the combination of high interest rates with high construction costs are just going to continue to tamper the demand and ability to build new home stock, especially for the first time buyer. That's the person that's really suffering, and they're the ones stuck in the apartments. So that's the apartments we're seeing demand for are bigger units with full garages, and a lot more amenities. Not your typical just rank and file starter apartment. Although in the downtown areas, we're still seeing demand for those small micro units too. But
yeah, I know.
More the suburban, what we're seeing this year.
Yeah, during COVID, everyone moved out of the metro areas, and now they're starting to filter back in. So, yeah,
very dynamic.
So back to the customer on the commercial side. What do you see as the primary customer focus on the commercial front in 2023?
I see it as just managing through a tumultuous time. I don't see a lot of demand for growth. It's going to be more of a protectionist measure. I just got out of a meeting before we jumped on this webinar, and we got the 20-minute conversation about all the different ways you can divide up the CDs with using this CDARS thing or with our wealth management team doing brokered CDs, but that managing risk and mitigating risk is going to be, I think, foremost for our clients, just because even though we're not seeing a lot of panic, there are a lot of people that are just more conservative that are going to want to take those steps to make sure that they're not in the ditch. Right.
Yeah, good point. I am going to close out the poll now. So if you haven't answered, go ahead and finish that up. And then we will look to see if anyone has put any questions in the chat. Okay. So it looks like on our poll, our first question was, what do you think commercial interest rates will do in 2023? And 57% said they were going to increase in the second quarter. Nobody thought they would decrease. And 43% said they were going to remain the same in the second quarter and decrease in the third quarter. So pretty much in line with what you said about increasing and then tapering off. What is one change on the digital front you would like to see in the commercial banking realm in 2023? 57% said fully remote closings. 43% said e-mortgages, fully digital process from application to recording. So nobody said no changes. So that's a good thing. What commercial real estate class are you being asked to finance most often currently? Self-storage was 29%, multifamily 57%, hotel motel 14%, new construction 71%. So someone is doing a lot of new construction. No agricultural lenders out there today, and then light industrial was 14%.
Okay.
And then what future commercial webinar topics? Because we're always looking for future things to talk about. 43% alternative commercial investment opportunities, 43% commercial rental markets from broker and lender perspective. 1031 exchanges, 57%. So thank you so much for filling out the poll. And, maybe the next one will be 1031s. So I can definitely speak to that, and we'll have someone else too, maybe a CPA, come on board. As far as questions, we do have one. Let me look at that. So what effect, if any, do you see with commercial lenders being affected by the sustainability issue? So many commercial banks loan to heavy carbon emitters. Do you see that banks are having more increased pressure with regard to this?
I am not seeing it in our level of institution. Bigger banks, they may. From a sustainability standpoint, we have tried to go all electronic and kill as few trees as possible with our files, which I know helps. But it being a knowledge business, there's limited things we can do within our own shop in order to kind of move the needle at all. With our customers, given that we're located in Michigan and serve, heavy industry, it could be automotive suppliers. I've literally never been asked to try to curb my lending based on a borrower's sustainability. So it'd be interesting to hear what other lenders have heard. I read a lot, and you hear things from some of the biggest banks, trying to promote certain agendas like that. But down here in the trenches in the real world, we're not going there.
Right. And that might be, as you mentioned before, it might be kind of a West Coast, possibly East Coast kind of thing, a coastal thing, rather than lenders in the Midwest.
Yeah.
So, we'd like to take care of all of our industries in Michigan. So, and then are there any specific areas that you see banks putting more resources into modernizing their products and technology in 2023? You had mentioned Horizon is working on kind of an onboarding online application type modernization. Do you see anything else out there that banks are tending to do?
This has been a quest for 30 years since I've been in banking, so it's not new. But one of the other big projects we're looking at is trying to improve the ease of which things can flow through our electronic approval system. Right now, we have one that's workable, but it's kind of clunky. We'd like to improve it, like to add on other things to make it all one seamless process. So that's another kind of dream that we have, which is because the system is an online system, but it requires a lot of manual intervention, right, to push it all through. So, at the end of the day, commercial banking is very much like one of my old leaders used to say, it's like a custom crafted, custom tailored suit, not an off the rack suit. So those systems that accommodate us have to be very flexible in order to accommodate that custom crafted suit. So it just makes it more difficult to create a system that accommodates all that variability.
Absolutely. I mean, we have the same issues with a title product too, especially on the commercial side, because there's more involved in that and more hands-on type thinking and decision making.
Sure.
So, and I think you have two perspectives. You have the consumer's perspective, is this streamlined online, but then you have the back end where you're doing all the manual things. So it's really not saving you any time, but from the customer's perspective, maybe it is. So the ideal world would be for everyone on both sides of the transaction to feel like it is saving them time, saving them money, saving the environment, all of that. So, okay. Well, absolutely. I'm assuming that other lenders are working on the same things. If you find that is an opportunity, a challenge they've had, an opportunity, I'm sure other lenders would agree with that. So,
absolutely.
Anything else you wanted to add before we end our webinar today?
Nothing specific, just good luck. And I'd say keep a positive attitude to everybody that's out there. I think this is more turbulence than it is signs of real problems in our economy.
Right. And I think we're better off than we were for sure in 2008. So, Janet, I want to thank you again. I really appreciate you being here and sharing your knowledge and perspective with us. And thank you to all the participants that joined us today. And we will send out another invite for our next one in a couple months.
Thank you, Maura.
So, thank you.